Well, good morning, everybody. Welcome to the ROS Media channel. I'm back with my good friend Ian Clifford. We're going to have another little protocol pep talk. We are going to be talking about mortgage liberation. But before we dig into mortgage liberation and why that is connected with today's subject matter, first of all, Ian, great to have you with us. We're going to talk about mortgage foreclosure today, aren't we? Why specifically do you feel this is an important subject matter to cover with the members?
Well, the majority of the membership isn't facing mortgage foreclosure, but for those who are, it's a major problem, and it sort of takes over your whole world. Because we've had a lot of our members facing this problem over the years, and I guess if you are, if you don't have alternative accommodation, then it's a major problem. If you're facing a foreclosure, if the bailiffs are likely to come and you really don't have anywhere else to go, and it's not easy to get anywhere else to go, maybe you've got a large family and it's not possible or easy for you to find anywhere else to go, then this is a major problem. And I think a lot of people get into extreme anxiety and have a mental reaction to it, obviously. And it can be very destabilizing. So for all those reasons, I know how you can get relief from it. So I want to tell people how to do that.
Okay.
I don't want to facilitate it for them, but I just want to show them that there is actually a solution. As I say on all my webinars, there is a solution to every problem. You just got to know what it is. And there is a solution to this. It's not something which fits in to our Great Escape protocols, because it's a little bit like claims management. It's, you could construe it as claims management, and I don't want to be involved in that. So
no, I get that. And just sort of for context, in terms of what's led you to what we're about to look at, we've got some specific documents and notices that we're going to share with you guys on screen in a moment. But going back to sort of 2019, 2018, when you started looking into this, could you just briefly map out that journey from when you started looking into mortgages and what's led you to where we're at today?
Yeah, I mean, it's been a journey that's actually really started in about 2015, when I first got deeply immersed in the banks are, creating credit ex nihilo, which means that they are creating credit by taking in deposits from the borrower, i.e. the negotiable instrument that you deposit with the bank. They take that in as an asset, flip it on their balance sheet, create a matching liability, and then say you'll find the mortgage in your account, which of course never existed before. And they're not lending you somebody else's deposits or anything like that. It is all created. It springs into existence when you sign the contract, and then you deposit your negotiable instrument with the bank, and that's where the mortgage springs into existence, as I've discussed and I think outlined on the infinite money. I think we covered that on there.
We did.
So I got deeply involved in researching that in about 2015, and because I was, without going into a lot of detail, basically when I was managing my financial services organization, I had over 1 billion that had been drawn down from Bank of Scotland, which was my clients back in the day when I did financial services and ran financial services companies. They had used credit from Bank of Scotland to buy assets, and those assets my firm was managing. And when the bank seized the assets, they used the credit line as the lever to steal the assets. So over 1 billion of tangible assets, not properties, these were investment assets, were stolen by HBOS in between 2008 and 2010. And that's the beginning of my journey into the pathway that I've been on for 15 years. So in 2015, when I was trying to get that 1 billion back for my old clients, I discovered that banks don't lend money. And that was a big revelation for me, which I didn't know before, even though I was allegedly a financial professional, I didn't know that banks didn't lend money, their own money, because I thought they did, and everybody I knew at that time thought they did as well in that sector of financial services. So it became something it was a big revelation for me, and I thought, wow, I've now got the silver bullet. I can go into the courts and go into the land registry, and we can help people to remove the mortgage. Because if the bank's never lent any money, it's got to be a fraud, isn't it?
Mm.
When we get to 2019, I came across a way which I thought was going to work for, it was called mortgage free. And that was if you could prove that the mortgage had been entered onto the charging register as a mistake, and that the word mistake is very deliberate, then you could have the land registry in the United Kingdom remove the mortgage charge. So I set about proving that mortgages were a mistake, because if it's a fraud, then it has to be the charge over the property has to be a mistake. The mortgage, in the language of the land registry, is a mistake.
Okay.
And there is actually a book written about this, which is called The Registration Gap, which was written by one of the very senior tribunal judges that sits above the land registry. And I'm trying to remember the lady's name. It'll come back to me in a minute. Anyway, I read the book and thought, wow, that means that every mortgage is basically a mistake. And if you apply to the land registry, you can get the mortgage removed, because that's what their indemnity policy says. They actually say that they'll do that if you can prove the mortgage is a mistake. And it's Clark. The book is written by, I think her name is Marilyn Clark or something like that. I've got the book still. Anyway, that's not really about what we're talking about today, but it started there. And then you realize that the land registry isn't going to ever admit that the mortgages are put on their register as a mistake, as they eventually wrote back, having spent nearly 2 years working on this. Although it may be a mistake, it's common practice for them to put the mortgage charges on the register. Now, you see, in the legal system, common practice becomes law. A lot of people don't realize that. Even though there's no statutory legislation, common practice can be deemed to be law. So even if there is no proof that the mortgage is real, in fact, it's the opposite, the common practice keeps the status quo for the legal system and the cabal. So that's what I discovered in between 2019 and 2021. And then I decided that we would then try and do it privately, and we'd agree privately with the mortgage providers that they had put charges on the register fraudulently. And you can evidence that mortgages are fraud, because the banks don't lend. If they're not lending, if there's no consideration in the mortgage itself, then, and they're charging interest on funds that were deposited by the borrower, then that's a fraud. I mean, there's lots of other reasons as well, but that's a fair-based fraud. So private law settlement was something that was tried for a couple of years. And again, the whole cabal, they closed round, they're not going to listen to that. And we couldn't make that work either. So then we moved into Carmel Butler, who read out in Parliament in 2011 that all the mortgages that have been securitized were fraud. And she read that out in front of Parliament. You can still find it on the Hansard review. So we tried that. And I actually tried that on one of my own mortgages at the King's Bench High Court, and served all the documents in line with the Carmel Butler statement. She was very senior analyst for Deutsche Bank, and she basically exposed that every mortgage that was securitized was a fraud. And if you go along with the book written by, I think it's Catherine Clark, The Registration Gap, which you can still get that book, then you can evidence that every single mortgage is a fraud, and therefore fraud eviscerates the charge, and the banks and the land registry should remove the charge. But then you discover that the High Court, that's the King's Bench High Court in the UK, they're never going to uphold a case, because if they do, that means that everybody else's mortgage could be struck off by going through the same process in the courts. So you get the sense that, you know, this almost is an impossible problem to solve. But I didn't give up there. I carried on looking into it because to me there's always a solution. And when I then looked into the role of the banks as nominees, that was the key. That was the key that unlocked the door to how to remedy this problem. But again, I don't want to facilitate it, but I absolutely know that this works. So that's how the journey sort of led. Many years, 10 years ago, I started looking at this problem. And it hasn't come easy to figure out what to do to solve it. So,
well, no, not when, as you said, you know, when it highly convenient for them to have this common practice in place. And I think if none of you recognize by now the courts and the banks are as corrupt as they come, then I'm wondering what rock you've been hiding under for the last few years. So it's a difficult thing, clearly, to take it into a courtroom. It's difficult to do it in private law by the sounds of things as well, because they would be setting precedent and they don't want to do that. So what's the solution? Because we've obviously had the I Am Free program that, again, with the best will in the world, we launched that because because we wanted to help people that were in situations like this, but yet again, trying to facilitate that on an individual basis where everybody's case is different is an impossible task. And I know we were chatting sort of just before we came live on air here, and that one of the difficulties with this type of service or this type of facilitation is it could be considered as claims management. So, you know, we can't be seen to be doing that for obvious reasons, specifically tied in with the FCA case against yourself, because that would just give them even more ammunition to shut the whole operation down, which clearly we don't want for ourselves and we don't want for our members either. Otherwise, we can't facilitate anything. So there has to be a workaround, and the solution that you've come up with, I think, in terms of these notices. Do you just want to give us a 30,000-foot overview of what that is, Ian?
Yeah, I mean, the thing is that this is not what I'm going to talk about now. Is not claims management, and what we offered in I Am Free was not claims management. So I want to be absolutely clear on that, because claims management is a very specific activity. And we've never, as an organisation, and nobody in our organisation has ever offered a claims management service. Because when you offer claims management, you're actually representing the claimant, and there is a specific, a claim is a specific term in the regulatory manual. It's a defined meaning of what a claim is. And basically, it's litigation. So if you are in litigation, that is a claim. And if you are claiming against a regulated company, then that is a claim. So you're either litigating against some body or some entity, or you are making a complaint about a licensed financial services provider. That becomes a claim, even though you might think it's a complaint. In the regulatory manuals, it's known as a claim. So you've got to be very careful that you're not making complaints or making claims on behalf of somebody else. Because if you are, then you're going to be in deep water with the FCA. I mean, I've never done that, or even though they say I have, or they say that I may have done, which is their terminology, not that I have. But you really don't want to get involved in that if you are doing that for other people, because that's a major problem from a regulatory point of view. So the situation that we find ourselves in now is that I've got this knowledge of how to solve the problem, but I don't want to advise people on how to do it. I don't want to do it for them. I could do it for myself, no problem, but I'm not going to be doing it for other people, and we're not going to build an infrastructure that does it for the membership. But because I've got this knowledge and I know it works, then I want to share that knowledge with the membership, because for those people that are equipped to use a set of notices and know what they're doing with them, I think this will be a great relief for their problem if they are equipped to use the notices. But what we don't want to be doing is just letting people use notices without any grasp of what they're doing with them, because if you do that, then you can actually make it worse. And then what we don't want is a lot of our members, emailing us or sending in messages to us in some way. Oh, I've just sent this notice out, and what do I do now? I've just had a response from one of the parties, and what do I do about it now? Because we're not in a position to provide that service, because that again would be advising people on what to do, and we don't do that. So generically, I can tell you what works and what doesn't, but we're not here to take individual cases, respond to individual members with what you should be doing next because something has just happened. This is what you do now. Because if you start doing that, then that is definitely an advisory service, which is almost certainly going to be construed by the regulator as claims management.
Yeah.
So I can tell you how it works. I can tell you why it works, and I can tell you what it's all about, but I'm not going to be facilitating it.
Okay. So just to set that expectation, guys, if you're watching this, we've got the tools, we've got the ingredients, but we're not baking the cake for you. Okay. That's how I'm going to leave it there. So as far as these, as far as these three notices are concerned, I also want to be clear on what this is and what this is not. So now we're on this little train of expectation. Let's keep on there for a moment, because we talk in these notices, and we'll dig into them in a second, Ian, but we talk in these notices about, discharging at the indentured trustee level. And if people don't understand what that is, we're going to dig into that in a moment. But what we want to be very clear on is what these notices are designed to do. And I think from the conversation we had prior to coming on, these are designed to give people breathing room, aren't they? That's what they're designed to do. So if, let's say that I was a member and the house that I was in was a mortgaged property. It's not. I live in a rented property. I don't mind telling anybody that. I'm not too proud to say we live in a rented home. I'm actually quite glad we do, in many respects. So we live in a rented property. But let's say this was mortgaged, and I was in arrears on my mortgage, and I'd gotten in a mess, and the bailiffs were banging at the door, and I was going into foreclosure. Now I've got a couple of options here, haven't I? I could think to myself, well, I'm going through the mortgage liberation program anyway, so I'm going to get my recoupment for my mortgage that will come through, and I can just pay the mortgage off. But in the meantime, I could lose my home, and I've got my wife, I've got my 4 kids, we've got the dog, we kind of like it here. And if this was our family home and we'd had it for many, many years, I would imagine that in a lot of cases, it's very difficult for people not to be emotionally attached to the property that they're in. So, the logical brain would say, it's just a house, go and rent yourself somewhere, just rent somewhere for the time being, let them take it. It's just a house. You're going to be able to, the silver lining to all of this is that even if they take the house, you're going to recoup the mortgage. You can then discharge that. Debt goes away. The discharge that you've just facilitated there, you can recoup that back as well and get the actual mortgage payment back that you made. Now you've got another pot of money where you can go and buy yourself a house for cash if you want and not have a mortgage. That's what the logical brain would say. And that might be what I would potentially say, but maybe the wife of the family or somebody who's a little bit more emotionally attached to the property might not want to go down that pathway. They might want to try and save the house. So what these notices are designed to do is give you some breathing room. And in all fairness, if you're in foreclosure, then you kind of, I know you've often called it the last chance saloon and the doors are shut kind of thing. So there aren't really a lot of options for you. You either do that, you either just let them take it, rent yourself somewhere, wait for your recoupment to come through, deal with it then. But if you are absolutely hell-bent on saving your property, this is going to be one of your best options, maybe your only option that has a high probability of succeeding to allow you to save the property until the recoupment comes through. Okay, so it's not going to eliminate your mortgage. It's not what this is designed to do. But let's talk a little bit about the actual notices themselves. I think maybe that would be a good place to come in. So there's three of them, isn't there? Do you want to just walk me through and walk the members through what these notices are?
Before we look at them, I mean, just to position it,
the
problem is not going to be solved in the courtroom.
No,
because we tried that. You know, I've tried it. I've tried it at the land registry. I've tried it in private law. I've tried it in the High Court King's Bench. So you're not going to solve the problem by going to war with the bank in the courtroom, because you're just never going to win. Nobody's ever won that argument, apart from one time. There is a case in Minnesota from about 30 years ago. It's called the Credit River case. Where a guy proved that the bank had never lent him any of their funds, any of their money, and the judge upheld the case and he won the case, and both the judge and the guy who won the case both mysteriously disappeared.
Yep.
And you can hardly find that anywhere online now. I've got it. I've actually got it. And it's like no judge anywhere in the world will use that as a case precedent.
No.
So you know that you're not going to win in the courtroom if you use that case, for example, as a precedent, which you should be able to, but they're never going to recognize it, right? So they kind of scrubbed it from the record. So the way to win this and give yourself relief and buy lots of time is to recognize that the problem is not a problem in the legal system. You can't solve the problem by trying. It's like, I think, who was it that said? It wasn't Confucius. It might have been Einstein. You can't solve the problem with the same ingredients. You've got to solve the problem looking at it from a different viewpoint. So you can't go into the legal system thinking that you're going to be smarter than everybody else that's come before you, and somehow you're going to win, and everybody else who's tried to win in the court didn't win, but you're smarter than all those guys, and you're suddenly going to win because you're trying to get the solution, approaching it in the same way as everybody else that tried the same thing and didn't succeed. So you've got to realize that the problem isn't in the courtroom, and it's not even in the legal system. The problem is in how the mortgage has been constructed from an accounting point of view.
Okay.
So the solution is in accounting. The solution is not in the courtroom or in the legal system. The solution, it starts with accounting for how has the mortgage been booked? How has that security been recorded within the system? Because that is accounting, and that's ledgers. And that accounting is being done at a much, much higher level than the mortgage provider or even the mortgage foreclosure court, whichever court that is, you know, the county court or whatever the courtroom is, the circuit court if you're in the US. So much higher up than this, you have entities that are known as indentured trustees, which is a term that a lot of people don't know what that means or what that is. It's basically they are investment banks that are holding the mortgage securities in bundles, and they have to account for what they're holding at the indentured trustee level. Okay. And they have to send annual returns in as to what it is they're holding. And as I've mentioned on my, in my books and on my webinars, and I think in our previous interview on the infinite money, the banks are operating as nominees for the holder in due course, which is the living soul who transferred their energy onto the monopoly board through the body corporate, which is the person, the birth certificate entity, onto this artificial monopoly board. And the negotiable instrument that was used to create the mortgage was deposited by the mortgage, or that's the alleged borrower, the person, and the bank took that, said, thank you for the deposit of that negotiable instrument. We are going to match that with a liability on the other side of our balance sheet. This deposit you've made is going to be abandoned, and we're going to record this liability as your mortgage, and you'll find that in your mortgage account. And then they're going to sell that mortgage security, which is a negotiable instrument, and ultimately it's going to be held by an indentured trustee. So it's a trust that all of these mortgage securities are held within, and every trust has an indentured trustee, and their job is to look after the beneficiaries of the assets, the res of the trust. Well, the banks, they presume that they are the beneficiaries of these indentured trustee structures, but they're not, because the beneficiary is the holder of the credit, the holder in due course, which is in the example I've just put forward, is the living man or woman that is representing the person who signed the mortgage contract. So the living soul is where the energy originates from, transfers that energy through a signature, but the person is the name on the mortgage contract as the borrower, but the living soul is the holder in due course of the credit that the bank used to create this accounting asset, liability. Let's find that in the account, and I've explained that many times before. Now, when the mortgage security is then transferred by the bank that pretends to be the mortgage provider, because they're not really providing a mortgage, they're providing a conversion of credit into currency, and then they sell the liability to the investment banks, and the investment banks trade that, and they trade it through holding it in indentured trusts, and then you have to have an indentured trustee. So the banks are pretending or presuming that they are operating as nominees under IRS publication 1212. They are actually acting as nominees for the true holder in due course, the true originator of the credit, which is the living man woman. And all the time that they record down in the accounting ledgers, which is what indentured trustees do, that the bank, that is the original bank and the investment bank that now owns the liability, they have that right to the liability. They are reporting in their sets of accounts and at the US Department of Treasury, because all the indentured trustees have to file tax returns, that they are in fact the investment bank, the indentured trustees, that they are the beneficiaries of the credit, and they're doing that because the record has never been corrected. They're not the beneficiaries to the credit. The holder in due courses, which is the living soul, that's who really is the owner of the credit. Ultimately, if you go all the way through the chain, it starts with the living man, woman who puts the energy onto the monopoly board through the person. The banks then start trading it. They're kind of doing their accounting tricks and pulling their exemption out of the hat, because they can show an asset and liability. They could create this liability through their accounting exemption. And actually, nobody ever corrects the record unless you know how. And that's part of the recoupment process. That is the recoupment of the credit, because the true holder in due course is going to show up and correct the record, and it's a correction of the nominee. So you're removing the bank's presumption that they are nominees for this credit. They're not, and the only way of doing that is to file a tax return via a fiduciary, which is the international grantor trust that we use in our tax filing structure. And I've recently written that as the Clifford protocol. It steps it all out, all the way through the A through Z journey of how that works.
So bank recoupment and mortgage recoupment are very, very similar in terms of how they're done, aren't they? It's still the same, or very similar filings in terms of correcting that record, like you said, and the holder in due course is only claiming back what is rightfully theirs. So if we go through the documents themselves, the first one is this notice of fiduciary breach. So we've talked about an indentured trustee. So notice of fiduciary breach, lawful discharge, demand to strike proceedings as well. Would it be helpful if I brought the document up on screen for the members to see, so we can walk them through that, Ian?
I mean, take a look at it. Yeah, and these documents are actually in our Telegram channel if you want to read them in more detail.
Okay, so we've got
this is a notice, and a notice has some weight to it. Once you've issued a notice, that actually means something to the court and to the mortgage provider and to the indentured trustee, because you're going to serve this on all of those three. But before you did that, you would have issued a negotiable instrument, and you would have sent that to the indentured trustee. So first thing is, you've got to know what an indentured trustee is. Then you've got to know which indentured trustee is holding your mortgage security, which takes a little bit of research. And then you serve on that indentured trustee a negotiable instrument, for which there are many templates out there, but I'll probably publish a negotiable instrument template in our Telegram channel. So you dispatch that, you tender it is the correct way of describing it. You tender a bill of exchange properly written up to the indentured trustee, and you're doing that under the Bills of Exchange Act 1882, tendering a negotiable instrument, which is also the US version of the Bills of Exchange Act, which comes from the Bills of Exchange Act, is UCC Article 3. So what you're doing is you're saying to the indentured trustee, as it stands, you appear to be holding the ledger as the nominee. You're taking that nominee position. I'm going to discharge the mortgage, not at the mortgage provider level, because they will just reject the bill of exchange, because they're not actually holding any. They haven't got a ledger anymore. They've just got a servicing contract. That's all they've got. They don't actually have they're not holding this asset and liability balance sheet, reporting obligation. They don't have that. The indentured trustee does. So because you're very, very honourable, you tender to the indentured trustee a bill of exchange, and that should discharge the mortgage on its own. Now, if the indentured trustee, and they don't really have any real way out of this, because if they dishonour it by sending it back, then it's deemed to be discharged because they've dishonoured the instrument, the negotiable instrument. And if they don't reject it after 72 hours, by the law of the Bills of Exchange Act 1882 and the UCC Article 3, they have deemed to have accepted it as a discharge. So there's not really anything they can do. And for those who want to know what would they do with it, well, they don't just put it in the filing cabinet. No, they actually take it to the Federal Reserve window, because they are an investment bank, and they can exchange that negotiable instrument for currency, which is what they do with all of the notes that they receive. They're called notes or bills that they receive. So they actually can get an economic benefit from
doing this. Yeah. Yeah. So why would they not do it? If they can get economic benefit from doing this, and this is a genuine, like you said, a bill of exchange, they can take it to the Fed window, they can exchange that for currency. Why would they not?
Well, they will take it and they will probably exchange it and they'll get the benefit of the currency. But you see, what the banks are doing is hypothecating the original deposit of the. So they, you deposit that signature. That's the negotiable instrument that creates the mortgage. They create this liability. Yep. But the real big money spinner for the banks and for the clearing banks, that's the banks that you get the mortgage from, and then the investment banks that are trading the securities. The real big money spinner is in securitization. They want to buy and sell those securities because they're hypothecating, they're expanding their balance sheet, they're creating more and more profit for themselves by not not discharging the mortgage. And even when people think they have discharged the mortgage because they paid it off, with fiat currency, the investment banks are still trading it. So there's a lot of hypothecation going on. So they don't want to balance the ledger because that slows down their profit train. In fact, it brings it to a halt if you actually discharge the mortgage at the ledger level. So that's why they don't like to do it. They have to do it, but they're not going to say, thanks for your negotiable instrument, the mortgage is now being discharged. But at the accounting level of this, the mortgage has been discharged by the negotiable instrument, right? So it's a gesture, it's a positioning. You are coming in as the creditor. And there are two reasons why you would serve a bill of exchange. One is because it does actually discharge the ledger at the indentured trustee level. But the other reason is that you are demonstrating your position as a creditor. And you're also being very honourable. Okay.
So this is where the there's sort of three sections here on screen at the moment. We've got the notice of lawful discharge, which we've just spoken about, but then also, as we touched on earlier, notice of corrective IRS filings, 1099 OID. Now, just for the benefit of the members, if you're not correcting the record, if you're not going through mortgage liberation and you're in foreclosure, would this work?
It's highly unlikely that it would work because one of the most powerful aspects of this notice is that the Treasury, they keep a record of all the securities, you see. So the investment banks are paying taxes to rent the credit from the original holder in due course. So they're kind of renting the credit, and they pay taxes every year to the United States Treasury on the use of the credit because they're operating under the IRS publication 1212 as nominees. So if you like, in easy language, they're renting that instrument that you deposited with them when you created the mortgage, and they have to pay tax on that. It's like a rent. And all the time that they've got the use of it, they can carry on renting it from the Treasury. So they're paying taxes on it because they're kind of renting the use of it. And whilst they're renting the use of it, they are hypothecating it so that they can expand their profits. All the time that they're using it, they can make more and more money from it. But in order for them to carry on, presuming that they are the nominee, which is basically the position of renting the credit, they have to, the indentured trustee has to send returns to the United States Treasury that they are actually the nominees for the credit. Well, in fact, if you correct the record and you do that through the recoupment of abandoned credit, because you're going to create an international grantor trust, that's all part of the Clifford Protocol, Infinite Money Protocol. An international grantor trust, as a fiduciary, is going to send in a corrective filing at the United States Treasury / IRS that corrects the ledger that says that the bank is no longer the nominee. No. The actual true owner of the credit has now filed a corrective return, which is the 1099 OID, and the return is being sent in by a fiduciary on behalf of the holder in due course, which is the living man, woman who transferred their energy originally to the person who signed the mortgage contract that created that deposit of the negotiable instrument that set this whole chain of events into motion. So now the true owner of the credit has turned up and has filed via a fiduciary filing. And that is what's caused the problem for the indentured trustee, because they can now no longer claim that they can use this credit.
No,
because they're no longer the nominee.
So this is an integral part of these notices having the firepower that they've got, isn't it? That you have to correct that record, because you have to be able to provide evidence that that's been done, and that's what the notices go into, isn't it? So we've gone through the notice of lawful discharge. We've gone through the corrective filings, the OIDs. Can you just briefly explain what this UCC Article 8 is?
Well, that's known as an adverse claim. So what you're doing there is you're saying, look, I not only have I sent you a negotiable instrument, because I'm being very honourable, I'm giving you more currency or credit that you can convert into currency, but I'm actually claiming that you're no longer to record this mortgage in your books, under your indentured trustee reporting requirements as you as the nominee. So I'm making an adverse claim. And if you don't discharge the mortgage and back off, basically, then I'm going to be making an adverse claim against the fact that the indentured trustee has fraudulently reported the mortgage in their books and records as nominees, but they're no longer the nominees. And because of the corrective filing, so you're giving them some additional credit which they can use. So that's an honourable thing to do. You're then correcting the record, and then you're telling them that if they don't back off, you're going to be making an adverse claim against their fraud, because then they would be then involved in fraudulently filing at the United States Treasury that they're still acting as nominees for this particular mortgage, when of course they're not, because the notice is putting them on notice that they have the record is being corrected. Where are you going to make the adverse claim? Well, guess what? All the indentured trustees have to operate under the Indentured Trustee Act of 1939, and they all have to have what's called fidelity insurance. So they're all insured up to the hilt by the big reinsurance companies. So you're going to make a claim there. Okay.
So again, just sort of going back to expectations, I think that maybe, members who are listening to this can already see that this is quite technical, and I know that these interviews that we've been doing are meant to make things a little bit easier to understand, and also just to put it into layman's terms. But I want to be clear, and I'm sure you do too, Ian, that this is not an easy thing to do, but it is possible. If you've got the know-how, if you've got the whereabouts, and you feel confident enough to execute this, then this is real technical stuff here that we're digging into, but it works. And I think that's the key. This is what will buy you time. This is what will give you the breathing room that you are looking for to save the house that you're in while you're going through mortgage liberation. But the mortgage liberation protocol needs to be in place because of the notice of correcting the IRS filing. So the 1099 OID has to have been done. That will be done through the mortgage liberation protocol in order to make these notices have any weight and standing. So that's the first thing. You must be going through mortgage liberation in order for these notices to go out. And the second thing really is that you need to have the confidence in yourself and whether that includes family members that are going to help you from a technical perspective. But there's a lot that needs, there's a lot of research that needs to be done here in terms of, like you mentioned, the insurance company. They're going to have to dig into that. They're going to have to dig into the QSIP numbers and where to find those and how to find those. So this is not straightforward, but it can be done, and it's very powerful in that respect. So that's the first notice. Obviously, there's a final section here: final demand for remedy. Following actions must be completed within 7 days. And then we've got a couple of other notices that follow on from this one, haven't we? So shall we dig into those second two?
Just before we move on, let's just look at position, right? So you would have served this, if you're doing this, on the court, on the mortgage provider, and on the indentured trustee, and you've already, you've already corrected the record at the United States Treasury. Because your trust, you've gone into the mortgage liberation or the mortgage redemption. It's probably the mortgage liberation is more appropriate for this, and you have basically corrected the record at the highest possible level, which is the United States Treasury. Now you're putting the liability for this in the courtroom is with the indentured trustee, and so they are the most powerful entity here. It's not the mortgage provider, and it's not the court, and it's definitely not you at the moment until you serve these notices. It is the indentured trustee. So they don't want there to be a foreclosure at the court, whether it's the Crown Court, Circuit Court, or any other court, because if that were to happen, it's going to expose their liability, which they're going to have to claim on their insurance coverage, which investment banks do not want to be doing, because it would be a claim for fraud, and that would invalidate the indentured trustee's standing, and the actual individual, man, woman, whoever that person is, could lose their job because they have been involved in fraudulently reporting assets within the trust, which violates the Indentured Trustee Act of 1939. So this is really powerful. The indentured trustee is almost certainly going to, in private, instruct the court and the mortgage provider to back off, because they don't want the problem coming back to them of paying out an insurance claim and probably losing their job as the indentured trustee.
So there's a lot riding on this for the indentured trustee, isn't there? Which is that's where the leverage comes in, isn't it?
Where the leverage is,
yeah. Okay.
If they've committed fraud once in their thousands of mortgages in their indentured trustee, investment bond, then all the other ones are going to be fraudulent as well and misreported. So you see, this is a big problem for them. Which is why which is why it all goes very quiet, which is why the court doesn't write to you and say, hey, we've just received your notice and the whole thing's gone away. Everyone just goes quiet.
Yeah. There's not going to be acceptance, is there? Because acceptance is setting precedent, like we've said, and they won't want to do that. But the beauty of this, and we've seen evidence of this with other people, is that it goes very, very quiet. From being quite aggressive to suddenly very, very quiet. And that's the breathing room that we're talking about here. So what we're trying to say here, guys, is don't expect to serve these notices and get replies of acceptance to say that everything's okay now and it's all gone away. That won't happen. But the physical reality is that it does and has, in other cases, gone very, very quiet, and that should be evidence enough to you as the person who wants to save their home that the indentured trustee has told the mortgage provider and the courts, back away from this, please.
Yeah, privately back away. Don't admit anything.
Yeah.
As soon as the court or the mortgage provider admits that this process has corrected a fraud, that's a major problem for the mortgage industry.
Yeah, huge. Absolutely huge. So hopefully, guys, you're starting to see that, yes, it's complex, that there's a lot of technical stuff here. There's research to do. There's stuff that you've got to implement. Like we said, we're not facilitating this. But if you've got the wherewithal to do this, then this could be a real saving grace for you,
Yeah.
potentially, in the situation that you find yourself in.
And
So
you've got one more weapon, which is the very last thing. It says that the FinCEN Form 111, an SAR filing, will be submitted.
yeah,
Now
do you want me to bring that? Do you want me to bring that notice up so we can go through the FinCEN notice, or do you want to do them in order?
Let's do that.
Let's get rid of that one. And what I'll do, guys, is I will also add the FinCEN report, because this one is, like Ian said, this is a secret weapon. So let me share my screen. And we will grab the FinCEN report, which I believe is this one here. There we go. So let me know when you can see this. Hopefully you can.
Yes, come on.
There we go. So FinCEN Form 111. Please explain, Ian, for the benefit of the members.
Okay, so indentured trustees they have to operate within the Indentured Trustee Act of 1939. It's very, very prescriptive of what they do. This is not something you play about with. If you don't follow that act, you can lose your job, and the bank can be fined by the regulators. So it's a serious piece of kit. The Indentured Trustee Act. Now, the indentured trustee themselves, that's a man, woman who's operating this with their name on all the documents, they have to basically put their reputation on the line. That everything that they're reporting, because they have to do annual reports, is true and accurate and all the rest of it, right? So they're putting personal liability on the table. Okay. And if you know that they are not counting correctly, you can make a report about financial fraud, because false accounting is fraud, and you can make something called a FinCEN report. So you can file a report which covers this, including the notices and what this notice here and the previous, documents that you've already served on the court, the indentured trustee, and the mortgage provider. That all forms a financial fraud report, which is a FinCEN report. And you're basically reporting the indentured trustee and their bank for committing fraud on the basis that the record has been corrected. They're no longer operating as nominees. You've corrected that. And you not only did you correct it, but you put them on notice that you corrected it, and they've still carried on operating as if they were the nominees when they're not. That's a fraud. And they can be heavily investigated for fraud, which they don't want. And this isn't the Crown Court investigating them for fraud, where it could all be rigged. No, this is the Securities and Exchange Commission.
Okay. This FinCEN, I mean, just for the benefit of the members, FinCEN, that stands for Financial Crimes Enforcement Network, doesn't it? Is that right?
Yes, that's right. Yeah.
Okay.
So you've got the SEC, which is the regulator that regulates all the banks. You've also got the full weight and force of the legal system, of the judiciary, of the whole weight of the law underpins what's called UCC, the Uniform Commercial Code, because all of these instruments, of these security instruments, negotiable instruments, have to fall under the UCC, which is the overriding securities law Bible of the whole world. So you've got major problems if you are filing fraudulent returns and you're an indentured trustee. You're going to lose your job. Your bank's going to be fined by the regulators, might even lose their license to operate this service. Massive. You're talking billions of fines here. So this is a major problem for them. And you can report, anyone can report a financial crime on this Form 111.
Okay. So once the notices have been served, notice 1 and notice 2, and what you said earlier on was that, well, they're going to take that bill of exchange to the Fed window anyway. They are going to exchange that for currency, so it will be discharged at the indentured trustee level. But if they're going to do that, and I'm just trying to think as if I was a member here, if they're going to do that, then why would this FinCEN form be even necessary?
Well, you're basically you're putting a lot of power as a creditor behind your notices. If it all goes quiet and everything goes very quiet, and you're now waiting for the recoupment of your credit, and you're going to discharge the mortgage with the mortgage provider, and then you're going to recoup the discharge, and now you can remove the mortgage charge from the register because you've actually paid the mortgage provider. So you're just giving them more currency, but you're not losing that because you're going to recoup it again. So you're not losing anything here. But if the court case continued, for example, if they didn't go quiet and the foreclosure were to continue, now you can file the well, you've basically got 3 levels. The first notice, it might go quiet. You then don't need to make an insurance claim. That's the fidelity insurance claim against the indentured trustee. If you make that claim, then you're going to have to also do the FinCEN report, because the FinCEN report is quoted in the insurance claim.
Okay.
To make it valid, the claim, you can't claim on the insurance if you haven't reported the fraud. So you're going to report the fraud by FinCEN and make a claim on the indentured trustee's insurance bond, which is what's called a fidelity bond. It's an insurance policy that investment banks have to have in order to operate as indentured trustees.
So if I sent Form 1 out and I'd done everything I needed to do personally for that, and I accept responsibility for the facilitation of that, and I sent the first notice out and it didn't go quiet, at what point would I then think, okay, now I need to think about sending notice 2 out?
You then serve your insurance claim, notice of insurance claim, and you do the FinCEN report at the same time, because your insurance claim includes the financial crime report. So you're now saying, look, basically, you guys, if you carry on with this foreclosure, you've now become more of a problem than you were before, because you were serving a notice on them before. Now you've basically gone nuclear here. You've gone to their insurance carrier and you've gone to the regulators reporting a fraud, and that's a major problem for them.
Yeah. So I hope you guys can see the power in this, because it is very, very powerful. It's a potential lifeline for you, and that's why we wanted to share this with you today. Is there anything else on this notice before I sort of bring this off screen, Ian, that you wanted to cover?
Well, it really is, and in many cases, it may not even be necessary to serve the claim against the indentured trustees' fidelity insurance. It may not be necessary to do the FinCEN. The original notice, the first notice, might be enough in order for the foreclosure to be halted. As you said earlier, doesn't mean that the mortgage charge is going to be removed from the register, because they're not likely to do that. Because if they do that, then that's kind of admitting that this process has worked, isn't it?
Yeah.
What you're trying to achieve is a standoff. It's a standoff where you know that you're operating honorably. You know that you've actually put them into a subservient position. You've now become the creditor. You're holding this threat of an insurance claim and a FinCEN report over them. So you've now got a lot of leverage. That's why it goes quiet. You may not need to do the insurance claim and the FinCEN report, but if you do, now you're carrying out your threat. You've weaponized their fraud against them by going to the insurance claim and the FinCEN. But your objective is just to keep the house, yeah. So you want the court to go quiet. You want the whole matter just to go quiet, and then whilst you're recouping your abandoned credit, which you're doing through your mortgage liberation process, you can now recoup that credit. You wait for that to come into your asset fortress protocol. Then you can discharge the mortgage at the mortgage provider level, and then you recoup the discharge. And now you don't care about the FinCEN report or the insurance claim, because you've now discharged the mortgage in exactly the way that they wanted you to, which is to pay them something in fiat currency. And now the charge will be removed from the charges register, and they've never admitted that they were engaged in fraud, which of course they never want to admit that.
So if you wanted a tongue twister surrounding all of this, they know, but they don't want anyone else to know. Exactly. That would be the way I would sum that up. And this is buying time, isn't it? Like we said, it's not going to make the mortgage go away. It's not necessarily going to stop you getting automated letters from the banks or from the mortgage provider, because they spit those out anyway. But if it all goes quiet from the indentured trustee level, that's the power that you now hold in your hand. The caveat to that, I would say, is this little section here, subject information. I do want to cover this, Ian, because again, going back to expectations with the members, these are the things that some of the things that you are going to need to be able to find in order for these notices to be served. So these are templates. You can see here, you're going to need to know who the indentured trustee is. So you're going to have to find out who the indentured trustee is, the bonding carrier, the nominee bank, and also the CUSIP number, the relevant trust and CUSIP number that is surrounding this mortgage that you are in foreclosure on. So do you want to briefly just describe? I mean, we've covered who the indentured trustee is. We know what that is. We haven't mentioned bonding carrier. Do you want to just explain what that is, Ian?
Well, a bonding carrier is an insurance company. They are insuring the indentured trustee. So in this example, BNY Mellon is an investment bank. You may not know the name of them, but they're one of the big investment banks. And you've basically got the next one is Travelers Casualty and Surety. That's one of the biggest insurance companies in the United States. They insure the investment bank against claims. So you're not going to know this. It's not going to say it on your mortgage agreement. Oh, the trustee is BNY Mellon and their insurance company is Travelers Casualty and Surety. No, you're going to have to research that. Now you could put in information request at the mortgage provider, and you could ask them for this if you've got time. They probably won't want to give it to you very quickly, but you have the right to know. You have to do research on this. You have to do online research, and there are ways of finding it out. And if you know how to do the research, then you can find this information out. The insurance carrier is more difficult, so you have to basically you can get that information from the investment bank, the indentured trustee. They have to tell you who their insurance carrier is. If you're going to make a claim against them, they have to tell you who it is. But you may not be able to find it online very easily. So you have to go to the indentured trustee themselves and find that bit of information out. If you want to find the name of the indentured trustee, you can go on to Standard & Poor's, which is a website. You can go and have a look at what they publish. There's Euroclear. They have a website. If you do some research, I'm not going to give it all to you, because if you're going to do this, you're going to have to do a bit of research, right? There are online databases that have this information in them. You have to know what it is you're looking at, and you have to do a bit of research. And if you're prepared to do all this, you're probably going to succeed with this.
Yeah. Okay. Well, I think if somebody is desperate to save their house, some people will try anything, won't they? They really will. And this is just one of those levers that you can pull, guys. So let me just stop sharing that document, and we'll come back to just myself and yourself. I appreciate you coming on again, Ian, and kind of going through this, because like we said earlier on, I don't think there's a whole ton of people that are in that situation. I certainly hope there aren't here at within our membership. But for those who maybe are watching this and they are, and they desperately want to keep hold of that family home that they may have lived in for many years and raised children in, and maybe sometimes even grandchildren, whatever it may be, whatever your reasons are for wanting to keep your property. We're not saying, oh, don't be silly, it's just a house, go and rent somewhere. We're simply saying that that would be the logical thing to do, and then you can buy yourself another forever home. That would be the less combative thing to do. That would be potentially a less stressful route to take. But if you absolutely want to give yourself some breathing room, this is the way to do it. But you have to be able to facilitate this yourself. We will give you the tools necessary in those 3 notices. I believe they're already posted in our Telegram group, Ian, is that right? So you've got access to them right now. Everything's there. The sections within the notices that need filling in by you, it clearly states what you need to put in there. It's just a case of doing some research, finding that information, using your noggin a little bit, and just putting it all together and then sending them out. And if that gives you the breathing room you're looking for, then great.
I can write something about how you find the CUSIP number, all the information. I can put a crib sheet together, and I'll put it in the Telegram channel so that you know what to do. That would be perfect. And I'll also put a bill of exchange in there, which you will need to use if you're going to do this. So yeah.
No, that would be amazing. So then everybody's got then the tools, and they've got a little kind of instruction sheet on where to go to find the resources that they need. And we hope this helps. If this saves your family home, fantastic. Just please understand that if you are going to go down this route, you need to know what you're doing. We don't want people getting into more trouble than they're already in by not understanding how this works. That's why we're shooting this video now. So you need to understand how it works. You need to be savvy with this and know what you're filling in. You need to get your research accurate as well. That is an absolute must. You can't fill this in with the wrong information and think it's going to work, because it won't. So as long as you follow those steps and you take responsibility for facilitating this yourself, if this buys you some time until your mortgage recoupment comes through and you save that family home, then that would be a great thing. So before we kind of finish, Ian, any final words to the members on what we've spoken about, just to, again, just reiterate expectations, anything I've not covered?
I think, the peaceful exit from the modern slavery system is to recognize and realize that the whole solution is in the recoupment of abandoned credit and taking out that rightful position as the holder in due course. That's where all the remedy is. And I talk about it a lot. I've written numerous papers on it. The Clifford Protocol, the Infinite Money Protocol is higher level. The Clifford Protocol is more detailed. I've written technical papers. I'm writing for Ecclesia Law, so all the technical papers are there. You can find them on our link tree to Ecclesia Law. I'm putting various technical papers into the Telegram channel as well, because I really want people to understand what's going on and what works. And a lot of people talk about things that they believe are going to work, and you can be deceived into thinking that some of these things a lot of people talk about work, but they can't show you any evidence. There is evidence of what we've presented today working, absolute evidence, and there's even more evidence of the abandoned credit recoupment working. So if you put 2 things together that have a track record of working, you should get the same result.
Yeah. Excellent. Well, we'll look forward to the next episode. I'm sure we'll be doing many more. But for now, guys, I hope that you found this informative. I hope it helps you if you're in that situation. I hope that you're not having to use it. I really do. But if you do, the tools are here. We'll put any other necessary resources that we can into the Telegram channel for you. And until the next episode, I hope you have a great day and we will talk to you soon. Bye for now, guys.
Bye for now.